Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 89, we're going to look at a relatively unused concept in drafting and in tax planning known as cascading powers of appointment. Now this relies on a very distant tax court case and relied on prior estate tax law prior to its current form, especially when applied to general powers of appointment, but nonetheless could be a good drafting strategy depending on the circumstances and how it is structured. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, just to warn you, this is going to kind of start with the basics and then pick up steam as we go along, so the meat and bones of this presentation is going to be in the last minute or so. But I always think it's helpful to create some context up front. And it's hard to do this subject justice, but I'll do my best to cover quickly the general rules surrounding the taxation of powers of appointment. Now, when it comes to general powers of appointment, usually for tax purposes, what a general power of appointment results in is the holder of that power of appointment being the owner of the assets for tax purposes. In the case of a lifetime general power of appointment, the holder of that power will be the owner for gift and estate tax purposes. So if the holder dies holding that power without having exercised it during life, then the property over which that power extends would be included in the gross estate for estate tax purposes. Similarly, if during life that power is exercised or is released or lapses, there would be a taxable gift at that point as well. Now, a holder of a testamentary general power of appointment usually just looks at a snapshot in time at death. That power can't be exercised during life, nor can it lapse or be released during life without any sort of manual action. So generally there's no gift tax consequence surrounding that power, but holding it at death without having exercised it means that everything subject to that power will be included in the gross estate. And I mentioned exercise. Even exercising it would include that appointed property in the gross estate as well. Now, you can release or disclaim a general power of appointment that's testamentary. It could be a gift, but if it's not, due to a disclaimer or otherwise, then it has to happen more than 3 years prior to death if there is a retained power under Code Sections 2036, 2037, or 2038 after that disclaimer or release. Now, with a limited power of appointment, there's only a tax consequence if it's actually exercised. So if it's exercised over an ascertainable interest during life, such as an income stream, there would be a gift of that income stream. And it's hard to do this anymore under most states' laws, but if it's exercised at death in a way that resets the rule against perpetuities period, that's known as the Delaware tax trap, that would also cause inclusion in the gross estate for that testamentary limited power of appointment that's exercised. And then finally, any application of the gift or estate tax as a result of this power of appointment, whether it's exercised, released, or lapses, will shift the identification of the transferor for GST tax purposes to the person who held that power of appointment. Now, from an income tax perspective, a person who holds a lifetime general power of appointment over the corpus of a trust will be treated as the grantor for income tax purposes. And with a testamentary general power of appointment, there's a step up in basis for assets that are included in the gross estate as a result of that general power of appointment, so long as that general power of appointment is not the product of a reverse gift, which is just a play by an original donor to donate property to somebody else, maybe through a gift or through a grant of a general power of appointment, with the idea of getting it back with a stepped-up basis. And if that happens between the initial gift and the receiving it back, within a 1-year period, there's just a carryover basis in that situation. And then finally, if there's a lifetime gift due to any sort of exercise, lapse, or release of a power of appointment, there's no adjustment in basis except to the extent that there's an actual gift or GST tax paid out of pocket on that exercise, lapse, or release. And then, if the grantor trust status is terminated due to a lapse or release of a general power of appointment or an exercise of one, that could be an income tax event in and of itself. Now, we've covered all those bases, so they're not perfect. Forgive me if I missed any points in that, but I tried to cover the 30,000-foot view of what's at stake here. Generally, in the past, people have drafted to look at this as a black and white thing, an either or, with there being a limited power of appointment or a general power of appointment, but with a very high estate tax exclusion amount and a high GST exemption, more often it's become popular to draft for a general power of appointment, especially by the use of a formula which uses up the unused exclusion maybe of a beneficiary. Now, formulas have been recognized, on limited basis, for in a case-by-case type of circumstance for GST tax purposes. But there's the hanging question out there of whether estate tax formulas for a beneficiary would get the same treatment. You can cite the AB formulas in estate plans between a credit shelter trust and a marital trust as establishing this precedent, but those are applied to a decedent who owned property and not necessarily to a beneficiary. So it's not settled whether the IRS would recognize a split limited power of appointment and general power of appointment universally for transfer tax purposes. And in the worst case, they would apply the general power of appointment to all property and ignore the formula and impose unnecessary estate, gift, or GST tax. So is there another way to avoid this risk? And the possibility here is what's known as the cascading power of appointment, where maybe you give a beneficiary two powers of appointment over the same property and don't split it out fractionally among the property by a formula. That would put the power in the beneficiary's hands to say, first, maybe they have a testamentary limited power of appointment, and if that limited power of appointment is not exercised, the remainder would be subject to a backup general power of appointment. So what this does is, instead of relying on a formula, it puts it in the hands of the beneficiary to call the shots and determine their own usage of estate and GST tax exemptions. That could be a testamentary formula in a will or a revocable trust, and maybe that works a little bit better. And the reason we mention this is because this was an idea brought up in a very old tax court case, Estate of Chisholm versus Commissioner. And what happened there is there was an old law in the estate tax regime which taxed general powers of appointment only if they were exercised. And in this case, we had a cascading power of appointment which was limited first, and to the extent unexercised, cascaded into a general power of appointment. And what the IRS tried to argue is that the entire power was a general power of appointment, but the tax court found and determined that the exercise of the limited power of appointment cut off any sort of taxation of the contingent general power of appointment. And even in that case, that general power of appointment wasn't exercised, but nowadays that would be of no consequence. So the big picture with this case is that the cascading limited and general power of appointment didn't convert the limited power of appointment into a general power of appointment so long as the limited power of appointment was exercised. Now, it wasn't clear whether that would extend to a situation where maybe the limited power of appointment was exercised in part and not necessarily in full, but it's still a possibility. But there is some danger here in that the restatement second of property, donative transfers, does treat a limited power of appointment as a general power of appointment if the unappointed remainder passes to the holder's estate. So you'd have to build in an express general power of appointment as the backup instead of just saying the remainder is paid to the holder's estate in order to create an implied general power of appointment. So might be a good idea, might not, but this is something to add to your arsenal of planning and your arsenal of drafting when you're looking at how to optimize estate and GST tax planning. Now, as always, if you have questions or topic suggestions, you can email me at griffin.bridgers@gmail.com. But thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.